taken home more than $480 million. That's almost $500 million. And that's difficult to comprehend for a lot of people. In 2006, you made a huge stock sale, and you received over $100 million in that year alone. Your company is now bankrupt. Our economy is in a state of crisis, but you get to keep $480 million. I have a very basic question for you. Is this fair?
On September 15, 2008, America's fourth largest bank, Lehman Brothers, filed for bankruptcy, setting off a financial wrecking ball that demolished global stock markets, pushing the world economy into what's regarded as a once-in-a-generation crisis. With $639 billion in assets, it was the biggest bankruptcy in U.S. history. This is how it happened. Lehman's collapse was a seminal event that greatly intensified the 2008 crisis and contributed to the erosion of close to $10 trillion in market capitalization from global equity markets in October 2008, the biggest monthly decline on record at the time. It was also the largest victim of the subprime mortgage crisis that swept through the global financial markets. The history of Lehman Brothers. Lehman Brothers had humble origins, tracing its roots back to a small general store that was founded by German immigrant Henry Lehman in Montgomery, Alabama in 1844. In 1850, Henry Lehman and his brothers, Emanuel and Meyer, founded Lehman Brothers. While the firm prospered over the following decades as the U.S. economy grew into an international powerhouse, Lehman had to contend with plenty of challenges over the years. Lehman survived them all. The railroad bankruptcies in the 1800s, the Great Depression of the 1930s, 2 world wars, a capital shortage when it was spun off by American Express in 1994, and the long-term capital management collapse and Russian debt default of 1998. However, despite its ability to survive past disasters, the collapse of the U.S. housing market ultimately brought Lehman to its knees, as its headlong rush into the subprime mortgage market proved to be a disastrous step. The prime culprit. In 2003 and 2004, with the U.S. housing boom well underway, Lehman acquired 5 mortgage lenders, including subprime lender BNC Mortgage and Aurora Loan Services, which specialized in Alt-A loans, made to borrowers without full documentation. Lehman's acquisitions at first seemed prescient. Record revenues from Lehman's real estate businesses enabled revenues in the capital markets unit to surge 56% from 2004 to 2006. A faster rate of growth than other businesses in investment banking or asset management. The firm securitized $146 billion of mortgages in 2006, a 10% increase from 2005. Lehman reported record profits every year from 2005 to 2007. In 2007, the firm reported net income of a record $4.2 billion on revenues of $19.3 billion. So, what is a housing bubble? A housing bubble is a run-up in housing prices fueled by demand, speculation, and exuberance. Housing bubbles usually start with an increase in demand in the face of limited supply. Speculators enter the market, further driving up demand. At some point, demand decreases or stagnates at the same time supply increases, resulting in a sharp drop in prices, and the bubble pops. Lehman's colossal miscalculation. In February 2007, the stock market reached a record $86.18, giving Lehman a market cap of close to $60 billion. However, by the first quarter of 2007, cracks in the U.S. housing market were already becoming apparent as defaults on subprime mortgages rose to a 7-year high. On March 14, 2007, a day after the stock had its biggest one-day drop in 5 years on concerns that rising defaults would affect Lehman's profitability, the firm reported record revenues and profit for its fiscal first quarter. In the company's post-earnings conference call, Lehman's chief financial officer said that the risks posed by rising home defaults were well contained and would have little impact on the firm's earnings. He also said that he did not foresee problems in the subprime market spreading to the rest of the housing market or hurting the U.S. economy. He was very wrong. The beginning of the end for Lehman. As the credit crisis erupted in August 2007 with the failure of 2 Bear Stearns hedge funds, Lehman's stock fell sharply. During that month, the company eliminated 2,500 mortgage-related jobs and shut down its BNC unit. In addition, it also closed offices of Alt-A lender Aurora in 3 states. Even as the correction in the U.S. housing market gained momentum, Lehman continued to be a major player in the mortgage market. In 2007, Lehman underwrote more mortgage-backed securities than any other firm, accumulating an $85 billion portfolio, or 4 times its shareholders' equity. In the fourth quarter of 2007, Lehman's stock rebounded, as global equity markets reached new highs in prices for fixed-income assets staged a temporary rebound. However, the firm did not take the opportunity to trim its massive mortgage portfolio, which in retrospect would turn out to be its last chance. Lehman's hurtling toward failure. Lehman's high degree of leverage, the ratio of total assets to shareholders' equity, was 31 in 2007, and its huge portfolio of mortgage securities made it increasingly vulnerable to deteriorating market conditions. On March 17, 2008, following the near collapse of Bear Stearns, the second largest underwriter of mortgage-backed securities, Lehman shares fell as much as 48% on concern it would be the next Wall Street firm to fail. Too little, too late for Lehman. On September 10th, Lehman pre-announced dismal fiscal third-quarter results that underscored the fragility of its financial position. The firm reported a loss of $3.9 billion, including a write-down of $5.6 billion, and also announced a sweeping strategic restructuring of its businesses. The same day, Moody's Investor Service announced that it was reviewing Lehman's credit ratings and also said that Lehman would have to sell a majority stake to a strategic partner in order to avoid a ratings downgrade. These developments led to a 42% plunge in the stock on September 11th. With only $1 billion left in cash by the end of that week, Lehman was quickly running out of time. Last-ditch efforts over the weekend of September 13th between Lehman, Barclays plc, and Bank of America Corp. (BAC) aimed at facilitating a takeover of Lehman were unsuccessful. On Monday, September 15th, Lehman declared bankruptcy, resulting in the stock plunging 93% from its previous close on September 12th. The bottom line: Lehman's collapse roiled global financial markets for weeks, given the size of the company and its status as a major player in the U.S. and internationally. Many questioned the U.S. government's decision to let Lehman fail, compared with its tacit support for Bear Stearns, which was acquired by J.P. Morgan Chase Co., JPM, in March 2008. Lehman's bankruptcy led to more than $46 billion of its market value being wiped out. Its collapse also served as the catalyst for the purchase of Merrill Lynch by Bank of America in an emergency deal that was also announced on September 15th. Lehman Brothers' bankruptcy set off a financial wrecking ball that demolished global stock markets, pushing the world economy into what's regarded as a once-in-a-generation crisis. It's been a decade since the financial collapse of 2008. Some economists have already expressed concern over the rising debt problem, which may lead to a financial crisis worse than 2008. Do you think the next financial crisis has already begun? So, we will leave it right here. Hope you guys enjoyed the video. Thumbs if you liked it, subs if you loved it. See you guys next time.